Welcome back everyone to another video, and in today's video it's going to simply be just a really quick guide to trading futures, and how you can really get an understanding of it before you get into anything serious, for example. And jumping right into this, just some simple basics before we get anything else further. As the name suggests, a futures contract is a financial instrument through which a buyer and a seller agree to transact an asset at a fixed price at a future date. So really, it's just a derivative. That's all it is. It's a derivative product. Where in reality, for example, let's say you're trading the indices. You're not trading the actual. You're not owning anything, but rather you're betting on its future pricing. That's really all it is. Similar to, for example, options. When you buy a call or when you buy a put, for example, it's the same thing. It's a derivative product, except in this case, we're talking about futures specifically. And then continuing, it says that despite a futures contract providing the opportunity for delivery of an asset, most don't result in a physical delivery, but are rather used by investors to speculate on a security price or hedge risk in a portfolio. So this is what I was talking about before, where you do have the ability to also get physical delivery. For example, if you trade crude oil or any type of metals. But for the most part, most traders and investors are not going to be utilizing that physical part. Most will be engaging in shorter term trading, or even swing trading or long term trading. But really, that'll depend on you. But mainly, it's going to be non physical. And then after that, we say that traders can speculate on a wide range of securities and commodities by trading futures. And then some key markets that we have are stock indexes, energy, currencies, cryptos, interest rates, grains, forests, and even livestock. So you have a lot of different choices. Depending on where you live and the actual time zone you live, you have many different options that you could utilize getting into futures trading. And then some pros and cons. Starting off with the pros, first is leverage. Since these are derivative products, you're going to be utilizing margin and things like that. Where simply all that means is that you don't have to necessarily, if you're unable to afford the entire cost of it. Let's say, for example, you want to buy Nasdaq and it's like $20,000 right now. You only have to put down, let's say, for example, $1,000 for a particular trade. Now, that can also lead to some issues. Like, for example, here I have over leverage. So you have to be careful. It's a double edged sword. It gives you the option to do that. But does that really mean that you have to do that? No. You also have a wide range of asset classes, as I said before. It's easy to short the market. If you're shorting like stocks, for example, it's a little bit more complicated. But with this, it's really easy. You can buy and sell. So then you have extended trading hours as well. There's practically the market is open every day and at every hour. It'll close on Friday, open back up on Sunday. So really, you have a lot of options to really go for when you're trading futures. And then we also have liquidity. So with futures, they're very, very liquid, especially if you're trading the US indices. But like I said, there's many different exchanges that you can trade across the world and many different types of asset classes. But in terms of liquidity, these markets are very liquid. So you do have that option. But some cons initially, futures can be a little bit complex in the beginning. For many beginners, seeing this, it might be, sort of like rocket science in the beginning. But with given time, this it'll start off complex, but trust me, over time you'll start to get used to it over time. And then we have over leveraging, like I said before. It's easy to over leverage because just because the broker lets you doesn't mean you should. And then you must manage that contract expiration. So depending on how you're trading and your time horizon, it's really important to make sure that you know when that contract expires so you don't have any issues there. But like I said, mostly you're going to be day trading, or even just swing trading or scalping, so you don't have to worry about that. And then next we have failure to roll or close positions, which can lead to a physical delivery. Now, I mentioned this earlier when we were talking about oil. It's really, really important that you realize that if you're not closing your positions on time, especially if you're trading any kind of metals, forest, livestock, anything like that, crude oil, stuff like that, it can result in a physical delivery. So be, mindful of that. And then here I have some of the markets here, a little bit more detail. You have equity indexes such as S&P 500, NASDAQ, hard commodities, soft commodities. We then have energy, crude oil, natural gas. Then you have currency pairs, treasury securities, and then we have crypto. But these may vary depending on where you are located and the broker that you have. But the reason why I marked this, the equity index is green and the currency is green, is because most of you are going to reside between these two. Now, I know some of you, like I said, depending on where you're located and the hours you're trading, it might be better to trade other markets. But of course, these two are going to be the primary ones that you're going to be engaging in. And then getting started. So really in the beginning, I recommend starting with the U.S. equity indexes, or really any index based in the country that you're located in that would best suit you. For example, I understand that for anyone in Asia, since you're about 12, 13 hours ahead of the U.S. markets, for New York Eastern Standard Time, it might be better to probably trade the Japanese index futures like the Nikkei. You have the Hong Kong Exchange, I believe you also have the Singapore as well futures there. So there's a lot of options. You could even trade the European markets. But for most people, I recommend trading the micro S&P and the micro E-mini Nasdaq. And you're probably wondering, why did I pick the micro contracts? And it's simply so, as a beginner, you don't really have experience dealing with such large sums of money. And psychologically, it'll be better that you start on a lower foundation and you really get used to it. And then when it becomes almost boring to you, you slightly amp that up. And over time, you begin making your way towards the actual NQ and ES contracts. But really, I always recommend stay with micros. And some basic information, we see that these are all in Central Time. You just have to move it 1 hour forward for Eastern Standard Time, because they are going to be 1 hour behind. And then some quick specifications. Points, so it's going to be $5 per point. And then you have a tick, so there's going to be 4 ticks per point. It's just a easy way of understanding that there. And then it tells you how much it is per tick. And then same thing with Nasdaq as well. So it's really just, I recommend stick with these two. It's really simple. And getting started, or easy way to get started, is number one, assuming that you fully understand the futures markets and its risks, and you already have a consistent model and routine that you've back tested at least more than 1 to 2 years of paper trading or any kind of other analytical type of platform that you utilize with positive results, you can then begin engaging in this. Because if you don't have a model or a system that's not consistent and you're hopping from one to another, you're not going to really bode well long term. Some recommended resources I recommend is definitely check out ICT, check out his 2022 mentorship and 2023 mentorship. And he's also started a 2024 mentorship, so definitely recommend that. And also, you have a regulated futures brokerage. Make sure it's regulated and specific to the country you're operating in, and understand that the fees and leverage that you're associated with, and also the customer service. How good is it, if it's bad or not? You also have the trading platform. This is where you're going to be charting and doing your analysis. It's important that it also supports your brokerage account. I know some people that also, they put like a side by side, which is fine. Like one monitor the platform, one side the broker. But it's better to really have everything in one, so you're focused, solely on what you're looking at. Next is going to be internet speed. I recommend at least 50 megabits per second for download speed at a minimum. For upload, it can be, around 3 to 5 minimum. But really having a decent internet speed is important, so that when you're watching price, especially those of you who are scalping or day trading, you won't be having any kind of, entry issues or exit issues, or seeing price incorrectly or delayed. Having a decent setup is really important, so that that you're not going to run into any kind of issues or problems in the later future. Having something that's reliable and that's going to last you a long time is really important, and I highly recommend having multiple monitors. That's absolutely crucial, so that way you can see multiple analysis at once. And then lastly is going to be Google Sheets and Google Docs. Trust me, this is absolutely amazing. For those of you who have Microsoft products, you can do the same thing. Instead of Google Docs, you could use OneNote and things like that. It's really, really important that you journal. It's absolutely crucial. Most people just start trading and they don't do any journaling. So it's important that you journal yourself in the Google Sheets, so you can track your transactions, commissions. I have a spreadsheet if you guys want. It's going to be linked down below, so you could do that. And then also Google Docs, so that way you can write how you were feeling, what things you need to improve, your model, things of that nature. And lastly is the long game, which is the mindset that you're bringing into the trading. You have to realize that everyone's going to always start with that get rich quick, scheme, that they think that trading, like futures trading, is going to make them rich, overnight. But you have to realize that, there's a very few amount of people that really last in this industry. And it's really about your mindset, because at the end of the day, trading is psychological. It's, 80% psychological based. So what's going to take you furthest is being disciplined and patient with your model and yourself. Hold yourself accountable, but also, you know, just simply, understand that you're just starting out. So don't be too rough on yourself. Take your time, and within 1 to 2 years or more, it could take more depending on who you are, you'll be able to get to a level where your model can be consistent. Because, for example, you can have, like, for example, a win probability of only like 20%, but you'll still end up profitable if you understand risk management and equity management. Those are absolutely crucial going long term in this industry. So I really hope this video was insightful to all of you guys. Please feel free to comment down below if you guys have any other questions, and I'll catch you guys in the next one. Peace.